What have you not got if you're a retail trader? I'm talking about a guest in the market, a person with finite capital, relatively small amount of capital. You're not perhaps doing it all day long. You look at the market when you can, all those sorts of things. So what have you not got? What's your disadvantages? Well, number one is...
Is there something called stop hunting that takes place in the trading world?
It's always looked upon as negative, certainly at the retail trader level. Institutional traders are taught from their first day that they buy good levels or they don't buy at all. Unfortunately, most retail traders will...
So I am going to be a huge contrarian to everybody else who says, be careful, be careful, be careful, have tight stop losses, tight stop. But tight stop losses, I am certain, is the main reason why most traders don't make money. Because
So what have you not got if you're a retail trader? I'm talking about a guest in the market, a person with finite capital, relatively small amount of capital. You're not perhaps doing it all day long. You look at the market when you can, all those sorts of things. So what have you not got? What's your disadvantages? Well, number one is money. It is a big boys game, and if you think about it, you know, if you have a small amount of money, it's relatively easy to lose the lot. And for many people, it's game over when you've lost the lot of it. And so, people do feel that they can make a living and give up their day job and this sort of thing, and with my money. And they say, well, I've done well with trading, and so I'm going to give up my income and exchange it for trading. But think about this, and do this little calculation in your head. Think about, okay, I'm going to give up my job and I'm going to become a trader. What do I need to live and keep my family and to pay my rent and all those kind of things, and have not an improvement in my lifestyle, just the same lifestyle. Hopefully I'm going to improve it, but let's just say the same lifestyle, and say it's X amount of money. Now, let's say then, what return do I need to generate X? And don't forget, X is only to be the same as I am now. And let's just take some round numbers. Let's say £100,000, only because it's a big, it's an easy number for me to work with. So let's say I need £100,000 to pay my mortgage, to put my kids through school and all those things, which I'm happily doing with my existing job as a property developer or as a whatever I'm doing. And I'm going to swap this for this other risky job where I won't get paid every month if I'm ill and get the flu, and I have to stop working, nobody pays me, nobody looks after me, all those sort of things. But let's say I've got this amount and I've said it's 100,000. So what would be a reasonable expectation of return for me as a trader? So do you think it's reasonable to feel comfortable that if I traded for myself with my experience as I've been doing, as part-time, and I'm going to want to do it now full-time, that I could make a return of 25%, 50%, something like that? I feel comfortable that I could do that. Now that's a very big return, isn't it? Those sort of numbers. But let's say you do feel confident that you can do that. Then you must also look at the drawdowns that you've seen in order to get that kind of comfortable 50%. Presumably sometime you made more than 50% because that's just an average number for you. So what sort of drawdowns could happen? How many months were you not positive? Did you have to sit through negative returns in order to finally, eventually end up with this really large number of 50%? So then, let's say that you're happy and you're convinced and you're confident that you are that sort of person. And that is a tall order, incidentally. I hope you realise that. So it's very difficult to make 50%. Believe me, it is. And to feel confident that I'll do it next year and the year after and the year after that. It's a tall order to do that. But let's say you think confidently you will be able to do that. So then you say, well, 50% is now my 100,000. So how much do I need capital in order to produce the 100,000. So what's the answer to the question? 200,000. So I need 200,000. Now, but hold on, 200,000, but that won't be enough, because what about the drawdown? And so I will need some multiple of 200,000 if for example, the drawdown was a 50% or something like that on it. So I might need twice 200,000. So let's say it's 400,000, 500,000. So people really, really underestimate what they need to start with. And they say, but I've really worked hard and doing my job every day, and I turned 10,000 into 50,000, and now I'm ready to go. No, you're not ready to go. And one thing is actually very certain, is you're going to lose all your money. That's it. You are. You'll lose your money before you get into the profitable run. It's most likely not enough money to become a professional trader. And in my experience, and I have been a broker, this is the main reason. It's not to do with people not being good traders or not learning, not working hard enough, not any of those things. It's being undercapitalized. And it's just too near naught, you're just too near naught. You're trading you're in a big boys game, everything's big, and so you have not got many chances of losing, not compared to an institutional trader who's got many more chances of losing, and it's still game on for him. So the number one cause, I think, of disappointment, disillusion, giving up, all that kind of thing, is actually there was no chance in the first place because the people were undercapitalized in the first place. So, and it's a big shame, because a lot of the people also, let's say you might start with 50,000, which is a lot of money. Truthfully, is a lot of money to have spare to speculate with. You have to be quite a wealthy person to actually have 50,000 to speculate with. People often don't realize how long it takes to learn how to trade. And they start trading, and of course, if you want to trade and you want a profitable trade to be meaningful to you, and losing trade to actually hurt a bit as well. And otherwise, what's the point of it? So you might, let's say that a winning trade to be meaningful to you might be $2,000-3,000 or pounds, something like that, and a bad trade might be £500-700 or something like that. Ooh, ouch, sort of trade. If it's £20, well, who cares? But it's got to hurt a bit. Now the problem is you don't get many of those type of trades before, and you don't have to have an unusual bad run in order to run out of money. And it's a big shame, because the beginning is the learning process, and I've watched people learning and getting better, but their capital has been so depleted, and their 50 has become 10, and now they're beginning to get the hang of it and actually understand it. But of course, from getting 10 back up even to 50, where they started, 5 times as much is a very tough proposition. If they doubled their money, that'd be terrific, but they've only got it's only 20,000. So I think I know this is maybe disappointing news to a lot of people, but this is real world. The fact is that the size of the business you're in here is large, and it's unforgiving, and if you don't start with enough or start small enough, that's the other thing. And you see people want to trade bigger, particularly at the beginning, because they've got the money. So I'm a 10-lot trader or 20-lot trader, but you can learn as much from trading 1 lot and 2 lots. And start small and realize that most likely in any business, when you're learning at the beginning, it's a learning process, there's a cost in it. And the learning in this business is to lose money. Really, that's how you get the experience and skill from it. And you need lots of opportunities there. And if you keep at it, it is possible to come out the other side as a winner, but not possible to come out the other side as a winner if you've run out of money. Okay, so if you are one of those people starting this game, have a pot of money, trade small, really trade small. Trade for real. I'm not a big fan of practice trading because you've got to feel it. It has to leave your account and, ooh, ouch, yeah, you know. But, you know, it's too easy when it's just a pretend trade. You can just ignore it because it never really happened there. So it's got to be real. But, you know, losing £100 and then making £500 and losing 150 and making 300, you can learn a lot from that sort of operation there. And basically realise that you're on a learning game. And you've got to go through the apprenticeship, and if you happen to be lucky and win a lot at the beginning, you know, be smart and realise that that's just the run of things. You know, you could have started badly or you could have started well, but these are sort of random events there. It means nothing. It doesn't mean you're a great trader. You just started with a good run there. That's another thing. So the second thing is that typically in these institutional operations where you have got prop traders, so genuinely people trading like you but in a larger scale, what happens is that people are given an amount of money or amount of credit to trade with, and their job is to trade. It's not to protect the money and come back and say, you gave me $500,000 to trade with, and here is, I've looked after it, and you've got $500,000 back. No, that's not what they want. They want you to go and put the money at risk and trade large and trade aggressively and make significant amounts of money with it. They understand that you may lose the $500,000, but then they'll give you another $500,000 if they still feel that you will do it. Now, that isn't the case with a private investor. So they'll be recharged. They'll probably be recharged every year. Unfortunately, for many people, they're given more money. So it was $500,000 this year. They did well. They made $2 million with their $500,000. Then the institution will give them another $5 million. And now go do it the same, bigger there. And this causes big problems for people, because people can be good at one amount of money and not good at another. You think it should be in your head just a multiple, but you say, well, a normal loss for me with my $500,000 is 30, 50, 60,000. But then you make it 10 times bigger, and it's 300 to 600,000. It doesn't feel proportionally the same. It feels a lot more. And, human minds can't think proportionally like that. So a lot of traders come unstuck because of the level that they're at, these changes of levels, which often the boss will reset you at a new level of money. So they've got, if you like, that advantage, but they're under a lot of pressure, of course. Their job is to make money. People want to sit in their seat. There are other people, and if you're not doing it, somebody else will be sitting in your seat, and you'll be gone. That's how it is. But you can make unusual amounts of money if you do well in it.
Is there something called stop hunting that takes place in the trading world?
It's always looked upon as negative, certainly at the retail trader level. Institutional traders are taught from their first day that they buy good levels or they don't buy at all. Unfortunately, most retail traders will wait for some confirmation before they get in. That could be a candle pattern, could be a moving average cross, or whatever. Institutional traders will buy at the level. Now, most traders will put their stop loss a tick under the last low, and they will invariably put their stop loss at exactly where the institutional orders are. I think that institutional traders are just doing what institutional traders do, putting their entry points at very good levels. However, if you are trading at the institutional level, it's not always easy to get filled. At the retail level, if you want to buy 100 shares, you want to buy the pound against the dollar at a 5 or a point, you press the little button and you've got it. At the institutional level, it's not that simple, and you've got, on occasions, to actually generate the liquidity to get aboard. I don't think that anybody looks at where the stops are, but they will say to themselves, well, we know pretty sure that most of the stops will all be crowded around this obvious level. So they will bid the market at that particular level. All you need is one person to chicken out, and the markets are going to go where the bids are, and all those people will be taken out. So I think that if you do not think long and hard about where you're going to put your stops, that you're going to find that you can quite easily die in a sea of stop losses. Okay, earlier on we talked about one of my things that I think about all the time. And here's an exercise for some people. The next time you're just about to put a trade on, you pick up something heavy and you just go, poof! And then you write down on a piece of paper where you were going to buy and where you're going to put your stop loss. Don't buy it, but put an order in to buy it at where you're going to put your stop loss, and then just watch how many times the market goes to your order. Okay, markets will go to the obvious stops most of the time, and one of my rules is that I want to put my entries where the masses put their stops. So I think that you can think your way through most of that, but you really need to spend some time in being brave and getting in at a good level. If you don't get in at a good level, there's nothing that upsets me more than a guy saying that this is a very risky trade, I'll use a tight stop loss. That's just rubbish, because you'll get stopped out over and over and over again. The stop needs to be where the stop needs to be. So if your entry is sloppy, then your stop loss is going to have to be a red bus away from where you got in at to give yourself a chance of staying in the move. The average true range will help with that. Most traders will look at a stop loss of 2.5 times the average true range or something like that.
Is utilising stop loss orders a good idea for your regular trader?
So I am going to be a huge contrarian to everybody else who said, be careful, be careful, be careful, have tight stop losses, tight stop. But tight stop losses, I am certain, is the main reason why most traders don't make money. Because before a trade moves your way, it usually moves the opposite way, because the people in the market they have to make money from you, and they know they're going to close you out, because most of you have tight stop losses, so you never get to make money. I'd say if you're confident about a trade, don't have tight stop losses. Have a big gap between your stop losses. So if it goes down and it backs up to where you want, you're still in the trade and you're not taken out. I would say stop losses is the main reason why most traders don't make money, even when they get it right. When they know the direction is right and they still get taken out, it's because of your stop losses. I say, don't listen to anyone who says have really tight stop losses. If you are confident, don't have tight stop losses. You will lose money, even if you are right in guessing the direction.
Are they ever a good idea?
They're good ideas sometimes, but then I would say, if you're not sure about your trade, then don't do it. Don't do it. It's a good idea if you have a huge position that, over the weekend or whatever, some massive political event is going to happen, and by the time you can catch up with it, it's too late, you're wiped out. So in that case, it's good to have a stop loss. But still, I would say, don't have your stop losses too tight if you can help it. You have to judge where you are, what time of year you are, what's going on geopolitically, whether it's safe generally to keep your position open without a tight stop loss. Stop losses, I would say, if there is a research done, that people would find is the main reason why when they guess the market direction right, they never made money, because they get taken out. And the people who run the markets, they know their game. They know if they go down before they go up, they've taken you out.